Bill Gates is selling out of his tech stocks. Bill Gates, the world's richest tech entrepreneur with a net worth of around $125 billion, has decided to get rid of his technology stocks. And it makes me think, what does he know that the rest of us don't? Bill Gates has not had the best of times as of late, as he and Melinda announced their divorce after 27 years of marriage. But in this video, we will be taking a look at the Bill and Melinda Gates Foundation stock portfolio. We'll be looking at all the recent buys and sells so we can see how one of the richest people in the world is playing the stock market right now. So we'll be looking at the recent tech stock sells, what exactly has he sold, and is this a warning to investors? I'll show you the full Bill and Melinda Gates stock portfolio so you can see how it looks today. And then in the midst of all this selling, he did in fact make one new purchase, and I'll show you what that was. As always, if you do find anything useful in the video, be sure to drop a like, always very much appreciated. Okay, so every quarter, any investor with a stock portfolio of over $100 million must disclose to the SEC what exactly they've been buying and selling. And this is obviously great for us smaller investors, as we get to see how the big investors are playing the stock market. So let's take a look at what Bill Gates has been doing. Check it out. So this is the update for Q1 2021. And this is the big picture of everything that was done. So as you can see from first glance, this looks like a bit of a worrying picture with this sea of red going on. In fact, we just have one buy, we have multiple big reductions, and a lot of completely selling out. But let's dig down and find out what the true picture is. Starting with the sells. And as you can see, he's sold 100% fully out over 1 million shares of Apple. He's sold completely out of Amazon and sold completely out of Twitter. 3 huge tech stocks. And also selling out completely of Liberty Lilac, Group C and Group A. So what does Bill Gates know about tech stocks that we don't? Next up, everything that was reduced. We have 4.6% reduction of Crown Castle, nearly 10% of Caterpillar. Berkshire Hathaway is his largest position and reduced almost 12%. Canadian National Railway, almost 20%. Walmart sliced off over a third. United Parcel Service, 40%. 50% off FedEx, and then Liberty Global Inc. and Inc. C, huge reductions, 82% and 86%. So just note, this isn't Bill Gates's personal portfolio, as that is private and he still will have the vast majority of his fortune in Microsoft. This is the stock portfolio of the Bill and Melinda Gates Foundation. So let's see how it now looks. So this portfolio is now valued at $21 billion, made up of 17 positions. These are the stocks, and it's 45% in Berkshire Hathaway, 11% in Waste Management. We have Caterpillar, Canadian National Railway, Walmart, Ecolab, Crown Castle International. But it's worth pointing out that the vast majority of this portfolio is made up of 7 stocks. And the remainder, we have Schrödinger, United Parcel Service, FedEx, Coca-Cola FEMSA, Coupang, Grupo, a couple in Google, and then Liberty Global finishing off the portfolio. So take a mental snapshot of this portfolio and we'll compare it to the previous quarter. So this is what it was just one quarter before. And as you can see, it's actually a very similar picture. So let me just put these side by side so we can really see what has actually changed. So here was Q4 2020 and the latest Q1 2021. And you'll notice that last quarter it was 22 billion and this quarter it's only 21 billion. So in fact, this is only about 5% less. So the overall stock market has had a good quarter. So even though it looks like he was mass selling, it looks to me that he was just banking the profits and cutting things back to the previous percentages. He did chop out those tech stocks, so we went from 21 positions to 17, but I think the true picture is that he was just taking profits. So at first glance, it looked like Bill Gates had been aggressively selling stocks, which could be very worrying for investors. But when we compare it to the previous quarter, it looks more like he's just taking profits and trimming it back to the previous percentages. So he's just choosing to take profits instead of keeping everything invested for maximum growth. So those were the facts of what exactly has been done, and we can now try to speculate on why he's decided to take profits instead of keeping everything fully invested. And I believe it's because by traditional measures, the stock market does look really overvalued right now. Take a look. So starting with the S&P 500's PE ratio. And this is the stock prices divided by the earnings per share. So basically the stock price divided by how much profit the companies are making. And a very high reading means the stock price is a very high in comparison to how much profit the companies are making. And the low reading is that stock prices are a bargain when compared to how much profit the companies are making. So this one goes back over 100 years, and today's reading is 36.86. In over 100 years worth of data, there's only one time that the stock market has ever been this high. And this was the blow-off top of the dot-com bubble. So this signals that the stock market is very overvalued right now. And next we have the market cap. So this is the Wilshire 5000, representing the entire American stock market. And the market cap has now just broken through the $50 trillion mark. And the main thing from this chart is just how steep it's been growing. You can see this is nearly a vertical jump up. And this is more steep than the run-up to the dot-com bubble. It's steeper than the rally that followed after the great financial crisis. It's even steeper than the rally that followed. You can see this is almost going up vertical. Again, a pretty worrying sign. And when you divide the stock market cap by GDP, you get the Buffett indicator. And this gives us a percentage. This chart goes back to 1950, and you can see historically the trading range is between 50% and 100%. It only blew up in the dot-com bubble to a reading of 150%. Great financial crisis didn't get as high as that, and then this is where we're at today. Current reading is 223%. So again, this indicates that the stock market is very overvalued. So by traditional measures, the stock market does look very expensive. And so it doesn't really surprise me that Bill Gates has decided to take profits instead of leaving everything fully invested. But remember, portfolios are always based on that person's specific circumstances. And I think in his stage of life, preserving wealth is more important than maximizing growth. So I think this does make sense based on his specific circumstance. Okay, so in all that selling, he did in fact make one new purchase. So let's take a look. And so what was the buy for this quarter? We have Coupang, and he bought 5.7 million shares. So who exactly are Coupang? Well, it turns out that it is a Korean e-commerce retailer. A very interesting pick. And doing a bit of digging, it's not just any retailer. Coupang is the world's fastest growing retailer. So South Korea's largest e-tailer, and it debuted in March on the New York Stock Exchange. So it did its IPO in March, and we'll find out how the stock price did in a second. Having reported a 60% year-on-year revenue boost, and its 5-year growth rate has been more than 100%, Coupang has overtaken India's Reliance Retail, which was named the fastest growing retailer in last year's survey. So let's take a look how it's done since its IPO in March. So we can see it IPO'd and the price started around about $50, and since then it's actually come down and crashed almost 35%. And it is on a bit of a comeback, but it's still down almost 20% since the IPO. So as you saw, not a great start in his new investment into Coupang. Since its debut on the New York Stock Exchange in March, it's still down almost 20%. And for me, this is a really important lesson for investors. Think about it. This was the fastest growing retailer in the world. It had a growth rate of over 100% year on year. Then we had one of the most successful tech entrepreneurs and investors deciding to invest in the company. And what happened? The share price went on to crash almost 35%. And this is proof that even the best investors in the world cannot time the market. So if you have ever bought a stock or maybe a crypto and it's gone down 10%, 20%, 30%, just remember this also happens to the best investors in the world. So it's a good lesson worth remembering. Okay, to sum up. It looked like on the surface that Bill Gates had been doing a lot of selling, which could be very worrying. But when comparing his portfolio to the last quarter, it looks like he's just been taking profits. What is quite surprising is that he's decided to get rid of his big tech stocks, Apple, Amazon, and Twitter, with just a very small position left in Google. And if you think you know the main reason why, feel free to share below. So there you are guys, hope you found this useful. In fact, if you did enjoy anything in the video, drop a like, and a big thank you to everyone who does. If you haven't yet subscribed to the channel, I invite you to click below and join us. I do have some great videos coming up that you don't want to miss. Okay, cheers guys, thanks for watching, and I'll see you in the next video. Bye for now.